the policy response and not the virus response following that in Europe has been better than the United States, right? We've seen activity restart, which is the way we look at how economies have come out of the virus in response to policies like Christine Lagarde had mentioned earlier. And what we note is that Europe is doing a better job in terms of containing the virus and thus allowing their economies to open. When we look at the percentage of economic growth, Europe is way ahead of the United States in regaining what it has lost. So in many respects, as we have liked European equities, the idea that from a fundamental perspective, the virus response has been better, more cohesive, more stringent to begin with, but that then has allowed the mobility to return and the activity to return. So, it's a theme that we've been working with for some time, really reflecting the policies primarily around the virus.
If you look at the U.S., the bulk of the sell-off has hit the technology stocks, which have been the prime beneficiaries of the rally since March, or have driven the rally, perhaps is a better way to say it. And at the start of that sell-off earlier in September, some investors were taking it as a bullish sign, as so far as it meant that investors were looking to access some of the more cyclical value stocks and come out of some of these growth stocks that have been viewed as a safer way to invest your money. Do you think that's a way we should look at it moving forward if we do see continued selling in tech, that it could actually be an optimistic or positive signal?
Well, I think the way that we think about it is that depending on obviously the outcome of the election and depending on the amount of fiscal spending, both COVID related and also U.S. infrastructure and sustainable energy related, we could see a broadening of and it's not just technology, right? It's the companies that have benefited in many respects from the crisis, the large, obviously, mega cap companies. What we would expect is not necessarily to see rotation out of that, but rather a broadening of that rally in a sense that would include kind of the smaller cap names that are part of that same kind of benefit from the COVID crisis. So not really necessarily rotation, but more broadening out into the smaller caps from the mega caps.
All right, very clear. Let's talk about the Fed. The Fed's new average inflation targeting policy has been a real focal point for investors over the last weeks. You seem to be firmly in the higher inflation camp. How do you see inflation developing over the coming quarters?
Well, we think this is one area where I think investors need to focus a little bit more, not for tomorrow, but obviously somewhat in the near term. Part of it is that the COVID crisis itself has reinforced a number of trends like deglobalization, for example, and like what we just talked about, large companies dominating the landscape. That's accelerated. And so we think those two things are in some respects inflationary, right? Deglobalization, bringing higher costs, higher production costs, higher input prices, but also the dominance of some of these companies that have been going for market share, right, now have the opportunity to actually begin to increase prices. At the same time, deglobalization has also led to, for example, in America, more onshoring, which gives labor more leverage in terms of higher wages. So, there are a number of things that the COVID crisis, trends that the COVID crisis has accelerated, which we think are inflationary. And then you add on to it, obviously, the average inflation targeting from the Fed, plus this policy revolution of combining fiscal and monetary policy together. Again, what Christine Lagarde was mentioning this morning. But, if you add all those up, in our mind, that is a more inflationary picture than I think investors have fully appreciated.